In this presentation, we'll be going over the bankruptcy and restructuring at Marvel Entertainment Group. It is going to be presented by Zachary Cagle, Galen Longo, Jake Neely, and Chandler Ryan. As for a brief history for the Marvel Entertainment Group, they originally started in 1939 by Martin Goodman. It started as a comic book series. Further down the road, Ron Perlman purchased Marvel in January 1989 for $82.5 million. Though through his holding company, the Andrews Group, financed with $10.5 million in equity. Following, Perlman had a reputation for purchasing underperforming companies and turning them around, and his holding company offered Perlman legal and financial protection. The limited liability protected the holding companies from financial liabilities in the event of a default. Also, consolidation with the holding companies allowed the sharing of net operating losses. There has to be a rise before a fall. We see that Perlman turned the company around by streamlining operations and eliminating unprofitable activities within the company. Revenues increased from $68.8 to $81.8 million, and net income increased from $2.4 million to $5.4 million in the first year under his control. He then sold 4.2 million shares and used the proceeds to repay the acquisition debt of $26.5 million, allowing for a cash dividend of $37.2 million to his holding company. In a span of less than 2 years, he almost quadrupled his initial investment with a return of almost 16 times greater than his original investment. This is Perlman's strategy, exploitation of net operating losses. The consolidation of subsidiaries had several benefits from both legal and financial perspectives. The consolidation allowed holding companies to share net operating losses across firms if they only owned at least 80% per the IRS. Perlman was able to control and manage his tax payments. The Andrews Group had to maintain 80% control of Marvel to utilize their net operating losses as offsets against potential tax liabilities for their other holding companies. And last, by utilizing Marvel's huge losses in 1996, Andrews Group paid very little or no taxes despite generating over $600 million in profits. In this slide, we will be looking at Marvel's acquisitions from 1992 to 1995. We know that Perlman's vision was to create a youth entertainment company using the comic book business as a foundation to build upon. First, we have Fleer, was acquired in 1992. The cost was $286 million. Fleer is one of the largest manufacturing of sports entertainment trading cards. Next, we have Toy Biz. Perlman found a stake in Toy Biz as this company designs and sells children's toys. Following that, we have Malibu and Harvey Comics, which were both acquired in 1994. These companies are comic book publishers. Next, we have Panini that was acquired in 1994. The cost was $150 million. This company is an Italian-based company that produces sports and entertainment stickers. And lastly, we have Skybox, which was acquired in 1995. And this company is the maker of trading cards, which Perlman acquired for $150 million.
Some of the conditions or market environments that Marvel was facing right before their financial issues started to unravel was that some of the companies they were purchasing were at a significant premium despite the shifting demand in the entertainment industry. By the mid-1990s, the entertainment industry was failing, and this was especially true for the comic books and trading card platforms. The trading card sales declined more than 30% between 1994 and 96, and they were reported as an attractive stock to sell short after a 33% drop in net income for Q1. Further challenges leading into the downfall of Marvel was created by their acquisition of Skybox in 1995. The S&P downgraded their debt from a B to a B- rating following that acquisition, and the total cumulative loss of $48.5 million was realized at the end of 1995. The challenges experienced in 1996 as Chapter 11 bankruptcy was right on the horizon. They had a total loss of $27.9 million through the end of Q3, despite their restructuring. Marvel announced plans violation of specific bank covenants due to the decreasing revenue and subsequent profit loss, and this really shook a lot of the investors. The stock fell 41%, bond prices falling over 50%, and these were just some of the many challenges that they were facing right up to their Chapter 11 bankruptcy. There is also a tale of insider trading entwined in Marvel's Chapter 11 bankruptcy. Putnam and Fidelity sold over $70 million in Marvel bonds in October of '96, just before the Chapter 11 filing on December of '96. They prevented an approximately $14 million in additional losses, and no charges were filed against Putnam and Fidelity, but it was either really good timing or they possibly had inside information. Some of the primary causes of Marvel's Chapter 11 bankruptcy started with their failed diversification in many lines of business. They had several business platforms and they were trying to dive into deeper media that wasn't fully understood at the time. They overpaid for Fleer and Skybox brands. The trading card industry had been in significant decline following strikes in professional sports. And along with the overpayment, the capital was 100% borrowed for the Skybox acquisition. Marvel should have read the market better and not purchased Skybox and considered further restructuring to mitigate problems.
Regarding the bankruptcy, the total loss for 1996 was $425 million, and a significant portion of that loss was actually a write-off of goodwill related to the trading card line of business. A non-cash charge of $370 million also reduced the stockholder equity to negative $245 million. This was Perelman's reorganization proposal. Firstly, he wanted Andrews Group to invest $350 million in Marvel for exchange for $410 million of new shares to ensure 80% of control was maintained. Secondly, he wanted to acquire Toy Biz to gain cash flow, which would generate revenue to help with the debt. And thirdly, he wanted the public debt holders to exchange debt with the face value of $894 million for equity in the newly recapitalized firm. However, Carl Icahn had an alternative restructuring strategy. He did not support Perelman's proposed restructuring plan, and he proposed for a $350 million cash infusion through the rights offering, only a couple weeks prior to the bankruptcy filing in '96. Perelman wanted to keep the bankruptcy cases separate. However, Icahn wanted the public debt holders to consolidate the cases and to assert themselves in an active role. The bankruptcy trustee appointed Icahn as the chairman of the creditor committee, a signal that debt holders would be involved. Perelman then amended his reorganization proposal. He hired Bear Stearns & Company to assist in the reorganization plan and officially amended the reorganization in January of '97. Instead of investing $350 million for 410 new shares like he first proposed, he was now proposing a $365 million for 427 new shares, less than half of its current price of $2 a share. Now that Bear Stearns has entered the picture, they believe that the current price of Marvel's common stock did not accurately reflect the value of the company, and liquidation analysis revealed that Marvel was worth more as a going concern than it was liquidated under Chapter 7. As under the liquidation scenario, Marvel debt holders would only recover about 70 cents on the dollar, while holding companies and debt holders and equity holders would receive nothing.
As we examine the income statement, we can get a clear picture of just how bold these projections are that Ron Perelman expects to accomplish at Marvel Entertainment Group. He's expecting a significant year-over-year increase in performance from 1997 to 1998 of over 20%. This is incredibly bold, considering all the moving parts in this deal. There's significant growth projected immediately following the reorganization, leveling off in 1999 with a constant growth averaging 3.41% over the next 3 years. By completing a sensitivity analysis, we can get a clear picture of the actual value of the equity given certain variables, such as terminal growth rate and the discount rate. The firm value is highly sensitive to fluctuations in the expected discount rate, with significant decreases predicted for just a 2% increase in that rate. The value per share is also highly sensitive to potential fluctuations, and even with a lower discount rate, the stock will not be reaching the price that it was before the announcement anytime soon, which was previously $4.62.50. By examining the fair market value of equity based on the forecasted projections, we can see that Icon's proposed rate looks favorable when compared to the 1996 projections. However, it is much less favorable in the event of a projected turnaround. This comparison illustrates the complexities of the case and once again brings to light the validity of the seemingly optimistic values from Bear Stearns' projection for the company. Based on the information in this case, it is clear that Marvel's creditors should vote against Ron Perlman's proposal and devise a new solution for reorganization. Liquidation could still be an option. However, liquidation would drive down asset values due to forced sale, and you'd likely see exit of key employees as well as a loss of customers. Marvel is worth more as a continuing operation, and there would be a significant cost associated with that liquidation, so they should definitely proceed with caution. Toy Biz may not agree to the purchase, as they may not want to cede control of their profitable company to a potential sinking ship. Carl Icahn wields a significant degree of influence as chairman of the creditor committee, and it would definitely be in the debt holders' best interest to seek an alternative. Thank you for watching this presentation. We appreciate your feedback, and we wish you a fantastic rest of the week. Thank you.